So in the summer of 1998, the S&P 500 lost roughly 20% in the span of 45 days. The decline was largely triggered by Russia's devaluation and debt default, which caused global panic. The S&P then recovered after a double bottom, rising roughly 65% in the coming 2 years before the all-famous dot-com crash, which saw the S&P lose around 49%. Now what's interesting is that Citron Research just dropped an analysis showing our current market looks eerily similar to 1998, that delightful year right before everything went spectacularly sideways. The VIX is currently lounging below 15 in July 2025, the long-term average 19.5. So basically, investors are about as concerned as someone binge-watching Netflix during a tornado warning. Fast forward to July 2025 and what's our situation? The S&P 500 continues busting out new highs. Meanwhile, the VIX has been parked under 15 since late June 2025. For perspective, this volatility index spiked about 50 back in April 2025, briefly reminding everyone that gravity actually exists. Here's a kicker. That April 2025 spike to 50 plus was like a smoke detector going off. Everyone panicked for about 30 seconds, then went back to whatever they were doing. The market breadth deterioration showing the exact same pattern as the dot-com era, because apparently we're determined to make the same mistakes with better technology. We're currently in that exact same complacency phase here in 2025. Both 1998 and 2025 show indices climbing to new highs, while the foundation resembles a Jenga tower played by caffeinated toddlers. So here we are in 2025, 27 years later, apparently determined to remake 1998's greatest hit album. Keep watching that VIX. When it wakes up from its current coma, things are going to get real spicy real quick. Despite this, Oppenheimer just raised their S&P 500 target to 7,100, and honestly, I'm impressed by the audacity.
The S&P 500 will close out the year at a new record high. That's according to Wall Street's biggest bull. It's John Stolfus of Oppenheimer. He's boosting his year-end target for the benchmark index to 7,100.
That's a casual 27% upside from current levels, because apparently we're living in a world where gravity is optional and stocks only go up.
We thought at this point, bring back 7,100. Fundamentals are improving. Look at the GDP print today. It ain't perfect, but it's certainly a lot better than the crew that was thinking we were going into a recession was thinking. And in addition to that, you've got earnings expectations not only meeting, but beyond expectations, another quarter so far. Overall, as Larry David would say, pretty good.
They're officially the biggest bull on Wall Street again, which is like being the most optimistic person at a bankruptcy hearing. But here's the thing, their technical reasoning might actually make sense, and that's either brilliant or terrifying. So why 7,100? Let me break down their totally reasonable logic. First, they're betting on earnings growth accelerating from 8% to 18% over the next few quarters. Because clearly, we're entering the age of corporate profitability, where companies just print money like the Federal Reserve on a caffeine binge. Secondly, they expect tech sector PE multiples to expand even further. AI software could go from 28 to 35 times earnings, semiconductors from 24 to 30, and robotics from 35 to 45. Basically, they think investors will pay even more ridiculous prices for growth stocks, which historically has worked out perfectly until it doesn't. The Fed rate cut cycle is their third pillar. They're projecting rates dropping from 5.25 to 3.25 over the next year.
We also have the probability, 66% for September, and just looking at, I want to do July, 2.1%. So really very low probability for July, but then two cuts built in for this year, 67% for September, 63% for December. So
lower rates mean higher valuations, which is Wall Street's favorite mathematical equation, cheap money equals expensive stocks. Here's where it gets interesting from a technical standpoint. Companies can maintain 12 to 18% growth rates through 2026, and if PE multiples expand due to rate cuts, and if AI continues revolutionizing everything, well, you see where I'm going with this. And honestly, who really cares about PE ratios in 2025? Look, could Oppenheimer be right? Absolutely. Markets have surprised us before, and maybe we are in the early innings of an AI-driven supercycle that makes the internet boom look quaint. Maybe Fed rate cuts will unleash a tsunami of liquidity that lifts all boats to previously unimaginable heights. Let's be real, when the biggest bull on Wall Street is calling for 27% upside, you might want to check if your portfolio is wearing a parachute. Not because they're wrong, but because when everyone's this optimistic, the market has a funny way of serving a humble pie.